Okay, hi everyone. Good morning, good afternoon, and good evening, and welcome to this panel on chasing risks, keeping up with the evolving consumer challenges in inclusive finance. My name's Anna Wallace. I am the Senior Programme Officer for Consumer Protection and Regulatory Technologies at the Bill and Melinda Gates Foundation, and I'm delighted to be your moderator today. Before we get into the panel discussion and meet our wonderful panel, just a bit of framing and then a little poll just to get us all warmed up and into the topic. So, in terms of the framing, the forces shaping the future of inclusive finances are clear. We've got the starring role of consumer digital data on one side, enabling regulations allowing new players to deliver services once only permitted by banks, and the advent of multifaceted regulatory frameworks cutting right across markets with things like open banking and data protection. And we've got all of this amidst developing economies that are grappling with climate change. We've got the changing nature of work and industry and the makeup of industries. And we've also got the recovery from the COVID-19 pandemic. What's less apparent is how this collision of these forces is going to affect and reshape consumer protection priorities and the agenda for inclusive finance community. And you've got some leading voices here today. They're going to be discussing the future of financial consumer protection, and they're going to share their perspectives and also give you insights from some of the incredible work that they've been doing to help, I think, could really redefine the industry's learning agenda over the next decade. But before we go into that, a couple of polls just to hear your voices. We will have some Q&A at the end as well. So I'm really interested to hear your reflections on the panelists. Okay, so the first poll, talking about de-risking technology. I've not used this before, so I'm assured it will be appearing in your swap card live stream now. So first poll question, have you done any of the following in the last week? If you have done more than one, and I'm assuming we've got quite, I hear we've got quite a tech-savvy audience here, pick the one that you've done most frequently. We've got 4 choices here. Used a gig delivery service like Gojek, Uber, Deliveroo. Considered making a purchase or made a purchase from a social media platform like Instagram. Sent or received money across borders with someone like Wise or Remitly or another money transfer platform, or used a hashtag in a social media post to join an online conversation. And I just posted on LinkedIn about this, but I forgot to do a hashtag, so I can't tick that one. For me, with 2 children under the age of 5, it's unfortunately the gig delivery service every time. What about you, panelists?
I think all of the above for me, Anna.
Yeah, I mean, yeah,
Yeah.
I mean, become so ubiquitous in our lives.
I know. We are just waiting for the results. What about you, Alex?
With the lead up to this week, there's been a lot of online hashtagging. So,
Oh, yeah, good point. Good
yeah.
point. Yeah. Matthew?
Actually, a lot of ordering of food, delivery services, and a lot of purchasing of gifts, actually, I've had to do online with vendors.
Oh, excellent. And Eric, what about you?
Yeah, I try to alternate, the shopping online and getting out of the house to get some fresh air also.
I know. Yeah, no, I know there's a difficult balance to be struck with being safe and not taking risks and trying to get a life again. Okay, I think we're having some problems getting the results. We'll give it a couple more seconds, then maybe we can move on to the next one. Okay, so we've got 15% sent money, 37% using gig economy players, 30% hashtag, which means 19% purchasing from a vendor. So the gig economy at the moment wins, which is a really interesting relationship with financial services and various different players that enable that kind of service. So next poll question. Now, thinking about the amazing opportunities that we can get from these digital services and the uses that we can use for digital financial services in the real economy. In the country that you live in or work in, what have you observed over the last 18 months regarding consumer risks, maybe not consumer risks, problems that you're seeing with digital financial services, things you're hearing, things you've observed, pieces of research that you've read? So in the country that you live or work in, have you seen those risks increase? Have you seen those risks decrease? Or do you think actually they've remained pretty stable and you haven't seen much change? Now, the problem with going out to the panel on this one is I'll give away what we're going to talk about in the future. I'll talk about the UK in terms of what's happening here, and it's been a lot of noise about pandemic-related problems, and a lot of that has unfortunately come from scammers. Okay, wow! Can everyone see that number?
Wow.
That's a big number. So 92% have seen risks have increased. So I guess that's why they've come to this session, and why it's so important from my perspective. I mean, I've spent the last 10 years working in financial regulation before I came to the Gates Foundation, and the last 5 years really trying to drive innovation that benefited consumers in UK financial markets. And it really is, it's not an easy task. You know, you're trying to ensure that there's a balance in terms of the welfare benefits that people can get from these digital financial services, whilst trying to understand not just the problems that exist today, but what might exist in the future, not just from those individual business models, but how everything is shifting. And that was a really, and doing it in a way where you're not dampening the benefits of the innovation or undermining, I think, one of the things that everyone holds dear in this panel, the critical aim of financial inclusion. So you're not increasing the costs by managing those risks. So I'm delighted that we've got people that can help us with thinking through all of these problems. And we've got a distinguished panel, as I said, with leading voices doing incredible work in this field. So panel, over to you. Be great just to hear a little bit about you and your work. And also, just if you could give me a sense of one force that you think is shaping the future of inclusive finance and shaping the landscape, I guess, by extension, in terms of consumer protection risks. Mahesh, can you kick us off, please?
Sure, Anna, thanks. And thanks very much for having me here today. My name is Mahesh Uttamchandani. I'm the Global Manager for Financial Inclusion and Infrastructure in the World Bank Group. And what that means is I oversee all of our technical work globally on payment systems, electronic money, our work on consumer financial protection and financial inclusion more broadly. And to me, and you kind of alluded to it in your first poll question, one of the big issues, I think, is really the growth of platforms. And of course, this has been happening over a few years, but we're really seeing it accelerate over the last couple of years, and then specifically during the pandemic. I think, if we look at an organization like Grab, in Asia, or Careem in the Middle East, I think they're growing at sort of 15-20% a year. I mean, really staggering year over year numbers, and have all moved from being, gig platforms to gig platforms and payments platforms, right? And ways of kind of building connections between services and customers that would have been impossible before. And I think one of the exciting things about platforms is that they are bringing more women into the gig economy and connecting more women as vendors to customers. And so certainly from a women's inclusion standpoint, from access to finance for women entrepreneurs, that's very exciting. I think because of their network effects and their ability to scale so quickly and grow so quickly, they can tend towards monopolistic behavior. And I think we do have to be a little bit concerned about that. And I think just because of their scale, they've become huge targets for hacking and for other sort of data management issues. And we've seen this with some of the larger platforms, and that poses huge concerns and risks to consumers.
Yeah, it's really interesting because it's really interesting the way the debate evolves very quickly from disruption, small, different, interesting to actually getting back into, I think, the more traditional concerns that regulators might have in terms of their ability to scale. So it's a really interesting and naughty, as in difficult to understand, set of issues with those business models. Matthew, how about you?
Yes. Yes. So Matthew Bird, I'm actually a researcher at Universidad Pacifico in Peru. So I have in-market experience, but I also am an affiliate Innovations for Poverty Action, where I work on financial inclusion and the consumer protection initiative there. And currently, between countries and continents, I'm visiting right now at Northwestern University, the Global Poverty Research Lab. Typically, my work seeks to identify how to better leverage technology and combine those with behavioral insights to harvest local solutions to issues of inclusive finance and particularly, especially now, consumer protection. And I work both in Latin America and Africa. Now, the force, I mean, it's probably obvious as a researcher, the force that I'm going to choose is data. Right. And I know perhaps others will choose that as well. But the take that I take on data is it is a double-edged sword. On one hand, Mahesh was talking about the platforms and all the monopolistic data that the platforms are accumulating and harnessing. But also, it's just the sheer amount of data that's being generated, the risks and the threats that it creates. I've seen this a lot in Latin America, both Africa, is the threats of leakage, of it being breached, of it being shared illicitly, of it being abused, the ability to really use that data. And the good way is, you can better target consumers, but also fraudsters can get a hold of this data and better target consumers. And so, really, especially in developing markets, I see the sheer amount of data that's being used, the protection that is needed for it, and these issues of privacy. It's a huge issue that I don't think anywhere in the world we really have a handle on, much less in developing markets.
No, you're absolutely right, and I think Mahesh is going to talk about this later in terms of when I mean, one of the great things about the financial markets in the past was those that fit within the purview of the regulator were the ones that really were in control of the activities. But now markets are being disrupted, and those that hold the data, share the data, may not necessarily be in that direct line of sight. And how do we understand that in this new technology driven world? Thanks, Matthew. Looking forward to hearing what you've done with the data going forward. Alex.
Sure, thanks. I'm Alex Rizzi, a Senior Director at the Center for Financial Inclusion. I've been here for about 9 years and have focused on our consumer protection portfolio of projects and more recently, the responsible data practices work. And the force I'd choose is to sort of drill down maybe into one of the data use cases that Matthew mentioned, which was the use of consumer data for targeting and eligibility, whether it's for products like digital credit or government-to-person transfers, eligibility for those programs during COVID. And we know on the credit side that mobile wallet transactional and payment history, airtime top-ups, device type, all of that is feeding into underwriting. And in many cases, it's for individuals with no credit history. On the government-to-person cash transfer programs, for our recent research that I'll talk a little bit more about, we found several governments that, like Togo, that use mobile money data from private companies to target beneficiaries for COVID relief payments. And of course, there are huge opportunities for these innovations, but also new risks. And I don't think we have a handle on a lot of them yet, whether it's data privacy and data sharing concerns, consent issues, function creep if it comes to governments having access to some of this data, and the risk of bias or incorrectly categorizing someone's economic potential when it comes to credit or their economic status when it comes to a G2P payment. And I think it's so hard to get a handle on for a couple of reasons. It's very technical. I think a subset of people have the technical acumen to code and create a lot of these tools that are being used. and we're still figuring out the best ways to engage with those tools to yield productive practices, but also respect proprietary systems.
Mm-hmm.
And I think a lot of those harms are less visible. If you think about the harm of a discriminatory loan officer, that's more visible and likely more identifiable by a consumer than a discriminatory algorithm. And if consumers are less likely to recognize those harms, they're probably less likely to complain and elevate that up to providers and regulators even. So I think not quite, we don't quite have a handle on those yet.
Yeah, but I mean, you're right. The pace as well with which this can happen is obviously a major concern. But I truly believe that by having the debates and exposing these risks, we can actually spur innovation that can really support it. Eric, last but not least, please introduce yourself and let us know what force.
Thank you, Anna. Hi, everybody. Eric Duflo. I'm currently leading CGAP's work on consumer protection. And sadly, I should have coordinated better with Matthew on the force because I had exactly the same force as he mentioned. So I had to find another one in the meantime. And I would say that not only we have this double-edged sword that Matthew has described, but what I see as a force is also the velocity of technological and improvements and digitization, and we've seen this during COVID, even before COVID, during COVID even more. And I think this digitization and this velocity is creating a kind of race. And it seems to me that consumers are racing to understand all these new apps, and regulators and supervisors are also in a race to be able to follow what's happening in the market. So I think it's a race that has started a while back and that is going faster now, and we need to be sure that everybody is going more or less at the same pace in the race. Otherwise, some will be excluded.
Yeah, absolutely. And I feel like there is there's an equilibrium that we will get to where we will better understand and better manage. And I often worry about the part before then, before we really understand what's going on, before everyone's on a level playing field in terms of understanding, before even the firms themselves understand. And that's the piece for me when something's quite nascent and new in the market. How can you enable the innovation, but keep close enough to understand really what's happening. Great, thank you very much, everyone. Thanks for the intro and your perspectives on the things you're most worried about. We're going to kick off now with a more detailed discussion. We're going to start with you, Alex, and the work that you've just actually referred to earlier around the social protection programs, the GTP programs, and how the pandemic has really accelerated access to digital financial services to enable governments to get that the well-needed support and relief to individuals in society. What are some of the challenges that you've observed for consumers in this process, in your work that you've done?
Yeah, thanks, Anna. Over the last 18 months, the Center for Financial Inclusion has published a series on policy responses to COVID. And about 10 months ago, we published a brief that cataloged how governments were rapidly mobilizing and digitalizing social protection with a focus on programs where new accounts were opened for the receipt of these payments. And of course, we know that other channels were also used, but this report focused on that. And over the past few months, we've revisited many of these same programs to understand what went well and what went poorly for consumers. And we'll be publishing a companion piece to that earlier brief by the end of this year. There's a lot that we've learned, but a few points that I thought would be relevant for this session. One is on program design and digital capability, and the other is on grievance redressal. And at every stage of these programs, many of these programs, from determining eligibility to opening and onboarding onto new accounts to the receipt of these G2P payments, digital technology was involved. And when it worked, it was efficient and scalable, and I think met the moment in terms of health and public safety needs. So for instance, in Brazil, 27 million Brazilians applied for the Auxílio Emergencial program through an online portal. But those same digital technologies led to points of delay or even exclusion for some beneficiaries, which was obviously harmful in a moment when households needed economic relief. And there could be many factors behind this, but I want to focus today on a misalignment, I think, in terms of expectations that beneficiaries had levels of digital access or digital capability that certain groups simply didn't have. A few examples on the digital access. For that same Auxiliar Emergencial program, there was a report that estimated at least 7 million Brazilians were excluded due to lack of internet access, and so they couldn't even apply for this emergency program. And in Togo, to receive a payment, you needed, among other requirements, a SIM card, and the government had decided that mobile money was the way to distribute cash in bulk. But of course, we know that women in sub-Saharan Africa are 13% less likely to actually own phones than men. So another gap that stood out for us was the expectation that low-income consumers could navigate these systems, especially when an error was made along the way. And these errors could be on the front end. For instance, in Togo, many applicants found that their voter registration information, which was needed to apply in that country, had been fraudulently used by another individual, and so they were blocked from even applying. In South Africa, thousands of applicants were booted off the eligibility list because of a back-end database issue. In Colombia, which I think is overall really a success story, where more than 700,000 new accounts were opened with 5 fintech partners, there were issues with one fintech when beneficiaries tried to change their phone number and those accounts were blocked. Or there was the issue of clawbacks where programs drew back the G2P payments if they weren't cashed out within a certain amount of time. Some of these timeframes were very short, 15 days in Sierra Leone, 30 days in Indonesia. And so when things went wrong for beneficiaries, we found there was a big onus on them to navigate the system that for millions of them was their first interaction with digital payments or digital finance. And we found very few interventions from governments that accompanied these programs to help inexperienced beneficiaries. We found that local, even neighborhood groups, civil society organizations often stepped in and filled some of these gaps to help beneficiaries on board. In Brazil, a lot of local church groups stepped in. In Africa, we learned about the African Reclaimers Organization, which worked with waste reclaimers to fill in and submit applications to receive these payments, and importantly, assisted when applications were rejected. In India, Gramvani was an organization that helped a lot, but these civil society organizations weren't built into the programs or formally part of them, nor were they compensated. So it wasn't necessarily a scalable support. And beneficiaries, of course, could complain and seek redress. But this brings me to our next, one of my next points, which is just overall, I'd say the grievance redressal mechanisms were fairly inadequate in helping when things went wrong for beneficiaries. The funding and staffing was underdone, and these programs were often inundated with high volumes of calls, some of them frivolous, and there weren't clear ways to separate or categorize the types of complaints that were being made. A lot of the systems were hotlines, which were designed more to just answer FAQs about the cash transfer program rather than actually resolve issues. Accountability for some of the complaints could run into cross-jurisdictional issues if a Ministry of Social Welfare was involved and the Ministry of Finance was involved, or it could run into value chain issues. For instance, if the government grievance redressal system wasn't working well, sometimes the payment service provider or the financial service provider would get these calls, and they often didn't have the authority to resolve a lot of them. So it was hard as a result for governments to know when things were going wrong for beneficiaries and to have some of these issues resolved. And we found it was sometimes the civil society organizations that brought the awareness or attention to governments to actually fix those issues. For instance, in South Africa, that database mismatch, it was a civil society campaign that pushed them to rejigger the application process.
Yeah, and thinking about consumer protection as a broader set of players and an ecosystem, I think really helps understand. It's not just the firm, the individual, the firm, the regulator. There are so many other players in a well-functioning consumer protection ecosystem. So there was lots, unfortunately, lots to learn in terms of what went wrong. So how's that shaped your thinking about the future?
Well, I think for a while, government-to-person G2P payments were pitched as this onboarding ramp to financial inclusion, but hadn't quite reached that potential. I think this time might be different, whether it was because of the way these accounts were designed, their extended use during the pandemic, or this larger trend towards digitalization during COVID. And so I think the worlds of social protection and financial inclusion might be intersecting more in the future than ever before, whether it's from time-bound shocks like a pandemic or weather event, or broader policy initiatives around the future of work, climate change, migration. So I think with this assumption that these worlds are coming together more in the future, in the immediate term, governments can do more to prepare for future crises and needs. To name a few things linked to today's discussion, investing in responsive and accountable grievance redressal mechanisms. And I say that first because as a consumer protection person, I feel complaints handling always gets mentioned at the end and gets short shrift.
Yeah, you're right.
And
it's kind of catch-all, isn't it?
Yeah. And I think being more proactive about partnerships with civil society organizations that can help for beneficiaries who are less familiar with these types of, with digital finance, and can also help with raising problems if they occur in a systematic way. And in the immediate term, I think more attention should be paid to data protection, not just for the millions of newly opened accounts and what to do with that data collected to date, but I think we're going to see more and more of private-public partnerships involved in beneficiary targeting. So maybe it's CDR data today, but it might be platform data tomorrow. Yeah. And I think these kinds of exchanges raise questions for us around consumer consent, de-anonymization of data, and data retention and sunsetting policies by governments. So
yeah, absolutely. Fantastic. Thank you. So Eric, Alex has been talking to us about a specific event that happened during the pandemic and what we saw in terms of risks and things that we can reflect on. CGAP's been doing a broader piece of work in terms of thinking about digital risks for consumers. Can you give us an elevator pitch on what it is you found, because it's really fascinating, both in terms of what you found, but also in the evolution of it, and also kind of what we know more about and what we know less about, which I think is it gives us a really nuanced picture. Thanks.
Thank you, Anna. Yes, as you mentioned, CGAP has been undertaking this research together with my colleague Marjorie. We've been working on this for almost a year. We really wanted to get a better picture of the evolution, both of the nature and of the scale of digital finance consumer risks. So what we did is we did a literature review. We reviewed about 170 publications from trusted sources. We also had discussions with about 70 experts globally. And we've come up with a typology of risks that I think is easy for everybody to use. The first risk type is fraud, such as SIM swaps. The second type is the misuse of data, such as data breaches. The third type is lack of transparency, such as hidden fees. The fourth type is inadequate redress mechanisms. And then we have found two cross-cutting types, which are related to agents and to network downtimes. So if you look at the nature of the risks, what we see is that there are some of the risks that are either accelerated or expanded by digital finance, traditional risks. And what we also see is that there are new types of risks. For example, mobile app frauds, AI-related risks, bio-ID risks, also theft of bio-IDs. So we're seeing new risks that also need more attention. If you look at the scale, we're also seeing an increase, a rapid increase. We had people say 92% of our participants saw an increase in their markets. Well, sadly, we've seen the same in our research. We've seen an increase of fraud and data misuse, both at national, regional, and global levels, with a few country exceptions. But overall, for fraud and data misuse, major increases in the literature and data that we have found. With regard to transparency, we've only found anecdotal evidence that the risks have increased, both at the global and regional level, so limited data, but anecdotal evidence. And for recourse-related risks, we have no reliable quantitative information, neither at global nor at regional levels, but there is mixed evidence at the country level. So if you look at the picture of these different types, you would see a lot of growth and very limited decrease of risks. What is most concerning, I find, in our research is that when I want to summarize it, and the elevator pitch is really that the size of the problem is going faster than the size of the opportunity. So the velocity I was talking about is not in our favor at the moment, because the risks are growing faster than the fantastic opportunity of technology. In South Africa, for example, SIM swap incidents between 2017 and 2018 have increased by almost 100%, whereas mobile cellular subscriber increased by about 10%. We also have data showing that the proportion of mobile app frauds has increased faster than the proportion of transactions being done using mobile apps. Same picture with data, record exposed compared with growth of data, more records exposed, faster growth, of records exposed than the growth of data created. So the conclusion is that it's really urgent for the entire financial sector, the entire ecosystem, to put in place tools to put tools in place to reverse this situation.
And yeah, I mean, it's a dramatic message that you have, but I know you, like everyone else on this panel, are absolutely passionate about financial inclusion, and the benefits that that can deliver in terms of poverty alleviation. So I know that's not the end of what you want to say. So what do you think? What's your call to action, Eric?
Well, I'll tell you a couple of things we're doing. I think the call of action is a general call of action for all different actors in the ecosystem to be more alert. So that would be my call for action. It's we need to be faster in terms of dealing with the issues that we're seeing. At CGAP, we also think that we need to look at the regulatory framework for consumer protection in a bit of a different way, with more focus on customers. We believe that it's important to look at what's happening to customers in their financial journeys, and not just ensure that providers are ticking boxes. So for transparency, for example, we would love to have more information on how customers understand prices and products, and that's what we call a customer outcome approach, where we look at what's happening to customers in this regulatory and supervisory framework in collaboration with providers, rather than just ticking a few boxes. So we've been working on this, and colleagues can share some of the information in the chat. Second, we're also working with supervisors, because they need tools. They need tools to better assess these different risks. In particular, for vulnerable customers, we believe that women and vulnerable groups are most affected by risks. So we're pulling together this toolkit, which is a market monitoring toolkit that includes different methods like phone surveys, mystery shopping, analysis of regulatory data. And we're also testing new approaches on the ground in terms of these tools. For example, in Peru, we're working both with the financial regulator and the consumer protection regulator to find new ways to gather consumer complaints. The third aspect we're working on is also on what we call elevating the collective consumer voice. We believe that consumers have not had the right seat at the table yet, and that they need a bigger seat at the table, so to speak. So we've been working on different fronts on this, different mechanisms. One is working with consumer associations, how consumer associations can help elevate the voice of consumers with regulators. We're also working on social media. For example, in India, we've been working with colleagues on using natural language processing to analyze Twitter posts and Google App Store reviews to understand consumer risks with regard to digital credit. And we're also working on what we call consumer panels within regulatory framework, within regulators, so that they have, regulators can have an ongoing dialogue with consumers. And the last point I'd like to make is for providers. Providers have an interest in being customer-centric. We have, we've published CGAP a customer centricity guide a couple of year or two ago, and we believe that it's a very strong business case for providers to be more responsible. So we want to work with providers to, set up systems that are better protective of consumers and that will be better for their business ultimately.
Fantastic, thanks, Eric. So it's an attack on the problem at absolutely every level. And turning to you, Mahesh, I mean, the World Bank have put out, some fantastic publications this year, from my perspective, and really a really comprehensive look at fintech in a general term and the consumer risks that arise specifically from these fintech developments. And I think one of the really interesting points is where the interests of the consumer and the fintech are not aligned, and what can and should and has been done to address that. It'd be great to hear a bit more about that now. Thanks.
Sure, thanks, Anna. I think it's important to note too, first of all, right, that conflicts of interest can arise between consumers and more traditional financial service providers. So we're not
absolutely.
We're not,
good point.
We're not taking aim as the fintechs, as I think trying to identify where some of these conflicts may arise and are maybe less well understood because of the novel ways that fintechs are doing business. And by conflicts, we mean, as you know, and I come from a legal background. I think the term conflict of interest is often misunderstood, but we mean specifically circumstances where the interests of the financial service provider really are inconsistent with or diverge from the interest of their client. So in our research, we found that fintech arrangements have been giving rise to some new examples of these conflicts, and have sometimes made more familiar conflicts that we all know and understand more opaque to consumers and regulators. So just to give you one example, in the case of peer-to-peer lending, a major source of revenue for many platform operators has been the fees that they receive for facilitating new loans between individual borrowers and individual lenders. And this can kind of influence them to adopt looser credit assessment standards to maximize the loan volumes and then therefore the fees that they collect. But it's of course in the interest of the individual consumers who are acting as lenders, who are going to bear the risk if the loans aren't repaid, for consumer borrowers who are going to suffer hardship if the loan is unaffordable, for the operators to ensure that they assess and price the loans appropriately. So ordinary consumers may not appreciate the potentially divergent interests here. Another example that we've identified both in peer-to-peer lending and in crowdfunding is that the platform operator may favor the interests of affiliated parties that participate on their platform over those of ordinary clients, such as, by allowing them to cherry pick lending or investment opportunities or allocate riskier offerings to, oblivious or unaware consumers. And there's a range of regulatory approaches that regulators can take to mitigate these conflicts. And a number of these approaches, again, they already exist in the traditional context, but the key is extending and adapting them to fintech in our view. So a general approach is to require fintech operators to implement adequate policies and procedures and effective organizational and administrative arrangements designed to prevent conflicts of interest from harming the interest of their clients. But regulators internationally have also found the need to target specific circumstances giving rise to the kinds of conflicts I mentioned. So for example, in Brazil, peer-to-peer lending platform operators are obliged to implement fees and charges policies that are consistent with viable lending to ensure that there's a convergence of their own interests and those of their clients. And regulators in a number of other jurisdictions have been restricting operators or their affiliated parties from participating in the lending or investment opportunities that are facilitated by these platforms. And I think it's also important to note that requiring disclosure to consumers of conflicts of interest and gaining their consent is also a frequently adopted approach, but there's an increasing recognition in the research that it's difficult for consumers to be able to avoid or mitigate the impact of these conflicts, even if they're aware of them. They may not understand the implications, and paradoxically, they may actually place more trust in the providers after the conflicts are revealed rather than less so. So I think disclosure on its own is unlikely to be sufficient, and is kind of a formal, approach to mitigating these risks that may not be practical.
Yeah, that's a really, really, really important and an interesting point. And as you say at the start, Mahesh, it's not that they're inherently riskier businesses, or that they have conflicts in a way that or that there is no conflicts in the financial system. And that was always my struggle as a regulator. They're like, oh, there's these risks and that risks. And to me, the counterfactual was, well, the counterfactual is still the banks. Okay, it's not a perfect system out there. These are new things and there are new risks. And often when you're a risk manager, you don't like unknowns, and you don't like things that you can't quantify yet, that are conceptual, where there's no historical data to use. So I think it's a great piece of work that you've done, and that you've really kind of grounded it in the business models as they're evolving, as well as obviously bringing to bear the rigor that the World Bank does in terms of the conceptual. And so have you got any advice, I guess, for regulators who are stretched in thinking about how, I think, for example, I think a really important aspect, which you didn't touch on, but I know is a big part of the report in terms of the perimeter, which we call as regulators, the firms that you've actually got your hands on, and the fact that a lot of the risks can arise from third-party providers who aren't within reach or direct reach of these regulators.
Yeah, I mean, and just to your earlier point, I think the key message for regulators, and it'll be well understood by most of the audience today, but is that fintech isn't magical, right? It doesn't.
But they do have unicorns.
That's true. That's true. I fell into that one, Anna.
What can I say? I'm doing this from a nursery, so I'm inspired by my surroundings.
But the stretching of the regulatory purview, I think, as you identify, is a real concern for the regulators we work with in emerging markets. And this is both true from the regulatory, but also the supervisory context. So first, of course, there's the concern with gaps in the regulatory perimeters that can make it harder for regulators to deal with such risks if they arise, even if they have the resources to do it. So a lack of a mandate to regulate fintechs or the powers to supervise them can be a concern. In our report, we discuss countries building towards a sufficiently flexible activity-based framework that applies financial consumer protection requirements by activity rather than type of institution, right? And I think this is sort of I think widely agreed upon, I think, at least by many on the regulatory side. And that'll help ensure that fintech entities are subject to certain obligations regardless of their institutional type or business model. So again, it's purpose-driven regulation as opposed to kind of ticking the box on formalities. And then as part of that framework, there'd really need to be a range of regulatory obligations increasingly being extended to fintechs and traditional providers to mitigate the kinds of risks that you mentioned. So having in place risk management and operational reliability arrangements and business continuity measures that are subject to vetting and competence requirements, and holding operators rather than the consumers liable in various circumstances, and really shifting the burden, I think, to the operators rather than the consumers. But a crucial concern, which we talk about in the report, is the ever-increasing focus of our own technical assistance and kind of our knowledge work on effective market conduct supervision. So it's important for regulators to be able to argue persuasively for adequate resources to address consumer risks and issues effectively. But it's also sort of a truism that regulators are likely to have limited or insufficient resources to cover the full range of providers and products and risks. So they have to focus on maximizing the effectiveness of what they do with the resources they have. And that means, among other things, leveraging tools such as market conduct supervisory technology, or SupTech or SupTech, as we've all started to call it, to support appropriate risk-based, supervision methodologies, and devote their efforts to the activities that are going to have the greatest impact. And I think it also means using data from the expanding range of resources to better inform what they do, including consumer-side research, monitoring the social and traditional media activity on digital platforms, and various types of industry-side data, right? So it's a tall order for regulators and supervisors that are living in this brave new world that I think we need to be concerned about.
Absolutely, and I love the mirroring this technological advancement in financial services with the technological advancement of regulators, and by matching that, you can also build their digital capacity as well, and hopefully make them more effective, which and make it more efficient. Which brings me on to Matthew's great work that you've been doing with Innovations in Poverty Action. I mean, you not only think it's possible for regulators to keep pace, but you think potentially they may even be able to prevent harm before it even happens. Do you want to talk us through the project that you've been working on?
Yeah, absolutely. Thank you so much, Anna. And much of this actually is kind of a drill down or a use case, if you will, of things that Mahesh has mentioned and
Yeah,
Eric has
absolutely.
mentioned as well. So this is a project that we've done with a regulator in Uganda, the Uganda Communications Commission, and they get complaints databases from all the M&O mobile money providers every month. And kind of we went to them and said, okay, this is a treasure trove of consumer insights and potential market monitoring data that you have. But what do you do with 200,000 complaints a month that are not standardized and what have you? And we actually asked we said, how can we leverage that? So we asked a couple of questions. So first we asked, what do these data points actually reveal, right? Because we know that not everyone who has suffered a particular abuse, for example, or a product issue makes complaints, so there may be biases there, it's kind of like the parable of the person, people in the dark room shining the light shining light on the elephant, right? It's just understanding what we have there, and then the second question we said is, besides kind of leveraging that and understanding what we have, how can we be more proactive? Because typically complaints are redress mechanisms, right? So we said, how can we turn this redress mechanism into something that's not just that's more predictive, right, and more preventative, and looking towards the future and not the past. So what we did for answering the first question, we said, okay, we've got all this great amount complaints data. We said, how can we triangulated, if we will. So we did a kind of a consumer market protection survey as well, and learned some surprising things. What comes up in the survey versus what comes up in the complaints are not always aligned. Sometimes they're aligned, sometimes they're not. And one of the things we found that between March and September 2020, right during the first 6 months of COVID, over nearly 50% of DFS or digital financial service users in Uganda had actually received a scam attempt or a fraud attempt, right? And so just the level, and if you only look at the consumer complaints data, those aren't quite the percentages. Although we saw some uptick in overall percentages, they're not fully reflective. And in parallel, we also had another team of PIs that were looking at social media monitoring, as Eric had mentioned, that he and his team are doing. And so we said, okay, so given these data, how can we know what we know is out there and get a better idea of this elephant? How can we take what we have at least? Because the regulator has access to all the complaints data. An individual MNO or mobile money, they may know all the transaction data, what have you, but they don't know what the market level of issues are, right? Or even the level of fraud. So we started to build kind of predictive models, saying, okay, we've got instances that a fraud have been identified. How can we? Is it possible? So this is our use case. Is it possible to actually predict fraud? And so we used machine learning techniques to do that, and we were surprised, even though we could get richer sets of data, even still, and that's the future of the project. We got about 90% accuracy with our prediction, and interesting things come out. Right, you learn about fraud occurs at certain times of the day and certain moments in the month. For example, when people are getting paid or the middle or end, we saw seasonalities of when fraud is occurring. We saw gender differences. We saw geographical targeting as well. And so then we said, want to take it to the next step. Okay, if we can predict this, and of course in the future you can work with MNO, with transaction data, you can work with social media and start to triangulate, can we be preventive? So how can we target our fraud messaging? Could we take this early warning system and actually use it to kind of trigger targeted fraud prevention messaging? So for example, for elderly or for women that we know are in certain geographies or certain times of the month or certain times of the day, in order to get to the people and really arm them, if you will, with the information they need, the tips that they need to confront these types of fraud attempts in the moments when they are most likely to receive them. So that's in a nutshell what we're doing. And of course, there's much more that we can say, but it's really how can we be more forward-looking, preventive, and predictive.
Yeah, yeah, absolutely. And there are definite use cases. I mean, I always look to the wholesale market when I think about innovation because that's where the money is. And there's a significantly, because the firms themselves aren't dealing with customers, there's less of an asymmetry, so that you see more innovation in these markets. And I think when I came into this field, there was a significant amount of that kind of technology being deployed to identify potential insider dealing, for example, within firms. And it's a pretty, as you say, the types of things you might not consider. We always talk about when someone doesn't go on a holiday, and it's because they don't want anyone to see what's happening on their desk. So it's a really fascinating opportunity. But you can see this potentially. It's in its nascent stage. How do we understand whether it's going to do what we want it to do in the first instance, and whether it keeps doing that once we get it in the hands of the regulators? So what do you think we need in terms of developing a kind of ecosystem that really supports the development and deployment of this kind of technology that could be used by regulators and supervisors? Because I foresee a minority report type event in the future if we don't create the right guardrails for deploying this.
Yeah. Well, I think just quickly a couple of points. One of the biggest challenges that we face is just the lack of the standardization of the data, even
Yeah.
among
Yeah.
MNOs in reporting. So that's a huge amount of work, but it's very needed. NLP, natural language processing, is fantastic, but if you're building predictive models, for example, you need to have a very specific outcome that you're training the model against, that you're trying to predict, and knowing that that is what you're trying to predict. So I think standardization of data. The second piece is actually stuff that other members of this panel have talked about and worked on. Is I think the nature of the relationship between the regulator and the providers, I think needs to be reframed a bit, because there's a partnership here for in working towards the consumer and working towards creating a healthier market, that I think they can work together better to achieve that. I mean, fraudsters are enterprises, right?
Yeah.
And they have enormous negative externalities, and these negative externalities have the potential to really greatly harm these emerging inclusive finance markets. And so, I mean, there's a way in which I think one can continue to frame. We're trying to do it. It's not easy. It takes work, right? But reframing that relationship in terms of you're working together to eliminate these negative externalities, such as fraud that decreases trust in the markets, that really kind of shrinks the market and the potential that you have. So you're working towards a shared goal as a regulator, and you're not at odds with one another, with the provider.
Yeah, absolutely. And I mean, we've got an absolute ton of questions, so I'm gonna go straight into questions from the audience. I think the first one that occurs to me is a comment around, and I think a lot of people have touched on this, around the activities and the types of regulators engaging. It going broader than just financial services. So I guess there's a kind of question around the opportunities and risks of having lots of different regulators. We've spoken about a competition regulator. There are clearly telecoms regulators, central banks. So it'd be great to hear someone's thoughts on the opportunities that might be there, because I'd like to end on some positive insights as well.
Well, let me just say, Anna, that I think, maybe not directly answering your question, but I think that it's imperative that these regulators, at a minimum, have an ongoing consultation with the industry and with consumer agencies to continue to learn more about these issues. I don't know that we'll get to a point where we have regulatory consolidation necessarily, at least within the government, and maybe that is an aspiration. But I think at a minimum, having this ongoing dialogue and through events like this is going to be critical to at least getting it right from a regulator's perspective.
Yeah, I think you're right. I think dialogue is often underestimated in public consultation. I wanted to touch on moving to a different topic. Eric, I'll tee you up to talk about your social media work in a bit more detail. We've had quite a few questions about that. But before then, Alex, what's your thoughts on the potential implications of lack of consumer at the point of the payment provider when it comes to G2P, and kind of what's your thoughts on there being lots of providers versus single providers?
Yeah, absolutely. I think in the programs that we studied this year, I think for a number of reasons, maybe the urgency and the need to get the payments out quickly, governments were often partnering with single or just a very small subset of payment providers or financial service providers to get the payments out. And as I talked about, I think with the range of digital access, digital capability, it's skills that consumers have. I think having more choice in terms of those providers would be beneficial for them in the future. And I think with some more ex ante work, maybe some service level agreements with multiple providers that are laid out in advance that could be deployed in the case of a crisis, I think that could be something governments could prepare for. And I know that the Better Than Cash Alliance, which is, I think, relaunched their responsible payment guidelines. I think that's one of the principles as well in terms of having consumer choice and multiple options in terms of the providers involved.
Yeah. And I guess in a way it affects how a regulator intervenes in a market as well.
Mm-hmm.
It doesn't always have to be a yes, no. It's just how if that's the fact of the market, then it needs to be regulated accordingly.
Mm-hmm.
I'm doing a lightning round here, Eric. Lots of interest and eagerness to know a bit more about what your insights were from the social media work that you did in India.
Yeah, so actually I'd like to start by saying that even though it's one of the most fascinating projects I've worked on, this social analysis in India on digital credit, I don't think social media is the solution for, everything. We have to remember that those people who use social media may not be the most vulnerable groups that we care the most about. So I think we have to be a little humble also about the social media. We're all making a lot of noise around it, but what we need is a mix of instruments to better understand the market, and social media is just one of them. What we found in India, for example, is that analyzing Twitter posts and Google Play Store reviews, it actually enabled us to tell quite early on that there was an issue in the market. We could see going backward that we could have predicted. Matthew, you were talking about predictive methodologies. This was not prediction, but this was very early warning kind of system that told us there were issues in terms of loan collection, in terms of transparency of consumer digital credit. So I think this can be used. But for example, we're working at the moment to try to understand who is behind these posts. In particular, we're trying to find out whether women are more affected than men, and we're having difficulties. We're struggling. So it's not, social media is not going to solve everything. We'll need other things. And there is also, other technologies that are less, maybe more approachable for low-income consumers, like Gran Vani in India has used IVR as a way to get, the voice of the consumers. So we have to think about, less technology-driven solutions also for the vulnerable groups who are increasingly excluded.
Fantastic, thanks. And I mean, it strikes me that links to the work that Matthew's been talking about this triangulation work. So you're like, okay, this looks interesting. How can we find out how this fits within the broader picture in terms of what we know from different channels? Sorry, Matthew, I didn't get a chance to ask you a follow-up question, and we've got lots of questions and points from the audience about transparency by regulators, transparency initiatives about microfinance, the use of blockchain to help with credit reporting to get a better understanding of. So it's a really broad range of questions. So it feels like this is a hot topic for people, and they are really interested and engaged in it. So I want to thank the audience for that. I'm sorry we didn't get the chance to talk to everything. Sorry, transparency and financial literacy as well. So lots to be spoken about. The good news is we've got lots more sessions available this week. I am being asked to highlight Better Than Cash Alliance plenary session tomorrow on the launch of UN principles for responsible digital payments. Senfrey Senfree are hosting a session tomorrow on how regulators need to adapt and develop new tools to deal with innovations in the jurisdiction. So question is about the transparency of regulators themselves is a great one for that session. Research ICT Africa and Senfree are co-hosting a discussion on Wednesday on risks, harms and opportunities for data-driven technologies and financial inclusion in Africa. Innovations for Poverty Action, Matthew's organization is hosting a session on Wednesday on how regulators can use admin data so we can follow up the debate that we've been having. And CFI are hosting a digital rights and consumer protection networking event to build connections between those working in the fields. That's some of the amazing stuff that's available. That was really difficult to get out in a quick space, and I don't think there is. Oh yes, we've got some content on demand tab, including a webinar on cybersecurity, financial inclusion by the Carnegie Endowment for International Peace, and the launch of the new client protection pathway from the Social Performance Task Force. So absolutely tons to look at and engage with. I want to thank the panelists for their insights, and I want to thank the CFI for giving us a platform to talk about these really important topics. Jayshree for being in the background to help us with questions and polls, and Alex and the team obviously from CFI for helping put the panel together and supporting us. And thank you everyone else for listening and engaging with us. I hope you have a nice day. Thanks everyone.
Thank you.
Thank you. Thank you, Anna.
Thank you, Anna. Thank you, everybody. Bye-bye.